Today is Wednesday, the 18th of February 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Now, if you sit on a board, you know this moment. You need money, capital, to hit milestones. So the market wants proof before it gives you the money. So you end up doing deals that solve cash, then quietly damage the equity story. And that's perhaps is not a good moment to face in the boardroom. So today, from the asset lens, I would like to see your how treat financials as an asset. The way you fund growth becomes part of your competitive advantage on or your weaknesses, right? So how you do it could be, let's say, we trust you, you are doing a competitive advantage here move, or it becomes a weakness. So there are three problems with this mostly. Number one is a no dilutive is often a label, and it's not truth. Even where you avoid issuing shares, you can still give away upside through royalties, pricing, convenience, or priority rights. So boards need to price the giveaway deliberately, not by default. There's a second problem too. The UK company law and investor expectations make dilution a governance issue, not just a finance issue. So preemption rights are set out in the Companies Act 2006, and shareholder dilapidation or this application is a deliberate choice, not a casual one. And I have an example here that I'm a company I'm watching in the London Stock Exchange that reports selling permits for £1 million and retaining 5% of gross royalties and one license and the 2.5% in another licenses, plus disclosing 22.5 billion shares in issue. So why this is the problem? So let me translate this in simple terms. This is less dilution now, paid for with less upside later. So we are not going to dilute now, but we are going to have less upside later. And the cap table makes every further raise more sensitive. It means actually we are not going to dilute now, but the upside later is going to be less. And if we have to rise again, it will be very, very sensitive because actually you start to get a lot of friction. So in other words, imagine funding is like oxygen. You can get it fast or you can get it clean. And in the board's terms, if the board's win is getting enough of both clean and fast oxygen, right? So here's a counterintuitive truth. The goal is not to avoid dilution, right? So listen to this. It's not to avoid dilution. The goal is to avoid uncontrolled dilution, right? So the meaning is you only issue equity when it buys you something that is worth more than the ownership you give away. So how do you make that practical? I use three board questions here. Number one, what is the cheapest proof point you can buy next? Not the full vision, the next proof point, the evidence. Number two, what can you fund by converting assets into cash while keeping some upside? And number three, if you do issue equity, how do you respect the UK market's fairness norms and your shareholder base? And here are three things to consider: a legal backbone, a behavioral backbone, and the Financial Conduct Authority. And let me go through this very quickly. This is where the UK frameworks help you think clearly when you do fundraising. So the Companies Act 2006 is the legal backbone. So the Pre-Emption Group's statement of principles is the behavioral backbone. It sets expectation for how no preemptive issues should be handled, including size criteria and best practices. And then you have the plumbing of the capital markets shifting under your feet. So the Financial Conduct Authority reforms to the prospectus regime include increasing the threshold for a further issue, requiring a prospectus from 20% to 75% of the existing securities already admitted to trading. That change process friction, not the shareholders' expectations. Now, this is very confusing. So we talk about frameworks, behavioral, how it's called, legal backbones, behavioral backbones, and then financial authority, reducing friction. So what is a key point really? The Financial Conduct Authority change makes some fundraising easier to execute. That's a key point. It reduces process friction. It does not change what shareholders expect on dilution, consultation, limits, and disclosures. Those expectations still come from the preemption rights under the law and the Pre-Emption Group principles. So in practice, all this means that you can have a deal that is easier to run from a prospectus point, but still needs to be sized and explained in a way the shareholders see as fair, right? There you are. So more simpler than that, I don't know. So as a board advisor, what I would propose to consider in this case when you are looking for fundraising. Number one, build a proof first funding plan. Define the next milestone that reduces risk, budget it, how much it's going to cost you, and then choose the least expensive capital that still lets you hit that plan. Use the UK secondary capital raising review logic. Speed matters, but so does market confidence in the process, right? So remember, the market confidence is something that you cannot neglect. It's a must have all the time. Number two, separate the sold asset from the upside. So royalties, earnings, or structured disposals can fund the runway while keeping participation in future wins. So the example before is retained royalties that shows the structure in action. So they retain royalties for the future upsides. And number three, if equity is needed, design it around the UK expectations. So understand the preempting law, use the Pre-Emption Group principles as your playbook, and communicate early with the shareholders so the raise does not feel like a surprise tax. So this is also where boards need to be honest about the cap table. If you already have tens of billions of shares in issue, every new issue becomes noisy. It affects perception, it affects liquidity, it affects your ability to bring in long-term holders. So you treat the cap table like an asset to protect, not a thing you deal with once a year with the board minutes. So why does this funding process approach matter? For three things: outcomes, differentiators, and risk reductions. In terms of outcomes, you leave with a one-page funding ladder showing which milestone you fund with asset conversions and which you fund with equity. So along with the maximum dilution you're willing to tolerate to buy the next proof point. In terms of differentiators, in the example I provided earlier, disclosed sale, retained royalties, and a very large share count, you can translate it into a repeatable board decision framework. And attention here, the important piece is a repeatable decision framework. What's inside is your own circumstances. Now, in terms of risk reduction, you anchor decisions in UK law and market practice, plus the Financial Conduct Authority update prospectus regime, so boards avoid surprises in process, disclosures, and shareholder reactions. One action you can take home today, and it's doable in 30 minutes or less. Take your last two fundraisers and calculate the percentage dilution each one created. Then set the board level maximum dilution per proof point rule for the next 12 months. Then you have a repeatable process with a kind of evidence of what happened in the past. So you have your rule for the next fundraising, right? So let's pause it here today and reconvene tomorrow. Because as you remember, yesterday I mentioned factors that delivery, when you're launching, what delivery is gates. Today is funding ladder, or so with the different levels that you have to hit for your funding. And tomorrow, I will show you how to build an operating model that scales output without scaling headcount, right? So you want a greater output without hiring more people. If you are a board member or a leader, and you want a B team looking at your funding structure, set up a 30-minute call so I can understand your position and how an independent international advisory board looking from the outside in your company can help you and your team without stepping on your toes, without a traditional consulting overhead, and without the public theater. Now,